current tech stock valuations, I mean, Facebook, Google, etc., and did you see it coming?
The reality is that I've been an investor in Google for a number of years now, and it struck me as somebody with a little bit more of a value orientation, an investment actually I found amazingly easy to make, because what I saw was that they were generating fabulous cash flow. And when I look at what are the most important drivers for making an investment decision, cash flow should not be underestimated. And I was, when I made my initial investments, this was under a corporate banner a number of years ago, Google was basically generating a near 5% free cash flow yield, which was phenomenal for a company that was growing somewhere between 15 and 20% a year and is still growing at around about those levels. So even though those free cash flow yield numbers have slightly come down just because the share has gone up so much, I would still say against the broader market, you can justify it because it's still generating a very good free cash flow yield and still has the growth and still has those structural positives that get me excited. So I would differentiate on a free cash flow yield capability perspective. So the most controversial one I would say at the moment would be something like Amazon. Because if you look at Amazon, you see a company which is apparently struggling to generate profits, but that's only because it's spending a lot of money developing its profile. Once they stop investing like stink in order to build up that distribution profile and revenue base, they will be a very high free cash flow yield generator. So consequently, you've got to be optimistic. It's the same with Alibaba as well. Alibaba's in exactly the same position, obviously entrenched within that interesting Chinese market as well. So I would differentiate on the broad array of technology companies based on free cash flow. And while some I like, there are some I like and some I don't like. You know, if you ask me which ones I own today, it would be the Googles, the Amazons and the Alibabas, and that would be differentiated and driven by the free cash flow yield generation.
But Apple?
So Apple's a fascinating one. I don't own Apple today. And I've been wrong, to be honest. Hands up, you know, I've been wrong. It would have been a very good and sensible and, let's face it, easy way to make a lot of money or a good return. But my problem with Apple is this: whilst I can see some of the barriers to entry in names such as Google or Alibaba or Amazon in terms of what they do, I see less with Apple. I see a company which is more directly consumer-centered, where the perception is based on quality of product and buying into the ethos. And let's face it, they've been wonderfully successful at doing that. I still wonder how successful they will be if you push that forward over the next 5 to 10 years. I may be wrong on that, and I may well need to reappraise that, and I do each quarter on its results, probably at a higher share price. but the reality is, at the moment, I still see some challenges, particularly as they look to redeploy capital away from highly successful products such as the iPad or the iPhone, and try and develop the next stage of products. I'm wondering whether actually you move into a different era for Apple, one where they offer a lot of capability as an income stock rather than a growth stock. And I think that's consistent with a change of share ownership base, which is also probably consistent with a change of share price. That would be my guess.